Welcome everyone to Buy, Hold, Sell Special Report. On today's market action, we saw stocks shoot to the moon after we heard about the ceasefire in the trade war between the United States and China. And with us today, with Tobin Smith and myself, Todd Schoenberger, we have Sam Stovall. He is the Chief Investment Strategist over at CFRA Research. Sam, we had to bring you in on the show. You are an expert's expert when it comes to this stuff with the markets. I have to ask you, though, President Donald Trump is doing a victory lap today. Is this his mission accomplished moment?
No, I think it's a little too early to say it's a mission accomplished. I mean, yes, they certainly accomplished more than the market had anticipated. The market thought that they would simply be sitting down talking about how they're going to set up the next talk and whether there will be additional ones. But I don't think that Wall Street anticipated that they would actually come to some sort of conclusion, such as reducing the tariff levels and coming out with another 90-day pause. So I really think that that scared the short sellers who then had to cover, and that's really what propelled the market today.
Yeah, Todd, I'll also add that we've talked about this last couple of weeks. My insider, Kevin Blumen, last name nameless, who's worked for every senator and every secretary treasurer in the last 30 years of GOP, called me last week early and said, Toby, here's what's going to happen. The GOP has got a little tribe together, and they're chatting with Mr. Trump. And here's what they're telling him. They're saying, if you don't freaking, and I'm using that word nicely, get out of this downward spiral, then we are going to not only lose the House, but we have a very good chance of losing Senate in the next year midterms. And if that's the case, then all this stuff you're doing is for naught. And oh, by the way, you sucked away $4.5 trillion of people's wealth. So hello. So Besant, God bless him, was the man. It wasn't that crazy Cantor Fitzgerald dude. I don't know what happened to him. He used to be a decent guy, but it was Besant who talked turkey, broke the news. And so that's why we went long, our AI data center and some of the transportation stocks, et cetera. And shouldn't be Gordon if it didn't come out that way.
No, I hear you. Sam, I have to say, though, with the markets, I mean, is this a great time to actually get out? I mean, because a lot of people were still holding on. We're now 2% above the Liberation Day target. So what do you think? I mean, would you recommend getting out at this point, or maybe just hold on and wait and see?
I would hold on and wait and see. I think certainly there's always the possibility that the market digests some of the recent gains. And yes, history does say that there's still a possibility that we turn around and set an even lower low. But when I talk to our analysts over at Lowry Research, which is our technical analysis arm, they give me more of a shorter term reading to say, look, it's the demand indicators that they follow that are surpassing the supply indicators. So there is still a lot more upside potential in the months ahead.
Well, Sam, you talked about the 200-day. Go over that history, because I thought that was very interesting.
Well, somebody asked me, Sam, we were down almost 19% from February 19th through April 8th. We since then have advanced by 17% and we're approaching the 200-day moving average. And so the question was, well, if we got this close, does that basically say that it's an all clear signal?
Right.
So what I did was, showing I have no social life, I went back to World War II. I looked at all declines of 10% or more and said, okay, if we had a 10% decline, if we then got within 2% of the 200-day moving average, and in some instances we were as much as 3.5% above the 200-day moving average, we still saw the market turn around and set an even lower low. So essentially, nearly 2 out of every 3 bear markets started as a correction, like a whale, got up, took a breath, and then went back down again. But our feeling is that, we don't really know if that's going to happen this time because it was a manufactured correction.
Right.
It's something that could easily be turned around, as we saw today. So it's a possibility, but it's not a likelihood in our opinion. And so I will continue to monitor the Lowry indicators to help, in a sense, to stay more on the shorter term track.
Okay, nice pitch for Lowry indicators, by the way. You're doing an excellent job.
Yeah, call Bigelow 66300.
Right. Well, but I would argue that in these other recessions that preluded a bear market, there were known knowns. And, historically, you could go to the playbook and says, well, when this happened, we get a recession, and then the stock market, comes back, and then halfway through all that pain and grief, we get like a 20 VIX day, by the way, which we got or the original sell-off. And when you get these 20 or 40 VIX, in other words, huge volatility swings, that's sort of now the rule that I go by that says that is a buying day. We got to a 60 VIX, as you know. I mean, that's like just everybody had to sell. It was a total blowout. I think people at home would learn, if you understand what this VIX rating is, a volatility rating. Man, when you see this 50 or 60 VIX like we had a couple of weeks ago, if you're a longer term investor and you're trying to build positions, but that's a buying signal. And what was different to me, Todd, about this whole thing was that there was no playbook for any of this. So the only thing that really worked was the thing that always works, was the volatility. When it goes batshit crazy, that's a technical term that they have at Lowry, by the way.
To add to that, Toby, we fell 10% in only 22 calendar days, and the average for all declines of 10% or more is 80 calendar days.
Wow.
Historically, when you have had a swift decline to that minus 10% threshold, the decline itself has been short and shallow, and that's exactly what we got, that down less than 19%, but then we pretty much bounced, and now the question is, will this be another one in that quiver of the short but shallow? And only time will tell.
Yeah, I mean, we're going to get more earnings, but we've got a heck of a lot of earnings reports already. And what's the record now? There's 1,200 CEOs who have said with the certainty of uncertainty. So we're not able to forecast. Well, okay. I'll tell you one thing though. Stuff that we were buying today was transports. I mean, RXOs, and I'm just looking at the list we bought today. I haven't bought JB Hunt in a long time. Okay, Sam, the trucking company, Forward. Oh my gosh, these guys were just decimated. And then the shippers, the Hopegs who sends the cars over to China or from China to Europe and back and forth, Matson. It's been a long time since I bought shipping and truckers and freight forwarders, for that matter. But that's sort of what you got to do here. I mean, they got so oversold that they're the ones that are going to come back hardest, right?
Exactly. Well, when you go back to 1990 and you look at whenever the market fell by 10% or more, in the 12 months after that market bottom, while the S&P was up 34%, the groups that held up the best in the decline, meaning healthcare, consumer staples, utilities, were up only 24%. And beat the market only 1 in 5 times. Yet the 3 worst performing sectors were up more like 45%. And the 10 worst performing sub-industries were up 60%. And we're seeing that today. The S&P 500 since the April 8th low was up 17%. The 3 worst performing sectors are now up 21%, and the 10 sub-industries are up 30%. So really, you got to hit them where they ain't, and you go for those groups that were priced to go out of business but did not, and therefore have the greatest upside potential.
That is so well said. I was really searching for that word. They were being priced as if they were going out of business, or they were going to bleed so much cash that they'd have to go bankrupt, crying out loud. And again, that was part of the pitch, I am told, that Bessent gave Trump, saying, listen, this supply chain thing, first off, Mr. Trump, let's understand, we're never going to put together phones together against China at $3 an hour or Vietnam $3 a day. Okay, yeah. So wipe that out of your little stinking mind. Now, I'm sure he said it, nicer than that. Then secondarily, what's being built, the manufacturing stuff that's being built, also requires actually people who can do this work. And that's been the whole problem all along, is that we don't have this. So I think the rhetoric is all for show. And the actuality of what this is going to happen is we are going to get a significantly more amount of high-tech manufacturing. We are not getting low-tech manufacturing. I'm not going to freaking Costco and getting my $14, nylon pants lined. All right, I'm willing to go $18. Okay, Sam. I mean, I'm Irish, so I'm Scotch. I'm cheap, but I think they're the pizzazzle shizzle that if you drive through parts of West Virginia and you drive through parts of the United States where there's big manufacturing plants that have closed, it's because they did not add enough value relative to doing it offshore. And regardless, the 145% was complete bullshit. I'll give Trump credit. It did at least get China. When you look at how many ships were upset in the last 16 days, zero. And you have layoffs of something like 1.5 million workers in China. He got their attention, and so maybe he is the master negotiator here. But it's just so strange to be a GOP Republican, lower taxes, higher, and to add tariffs, which of course are taxes.
So, and that does lead, I'll segue into that to going off of what Toby was speaking of regarding what's taking place inside the Beltway. But Sam, I noticed that Goldman Sachs tends to change their economic forecast based off of this tariff news. And it could be one social media post to actually change their opinion. What about for you right now, after hearing this overnight news, even though we now have a 90-day time limit here for this ceasefire of the trade war, is this going to change your outlook for the S&P 500 at 58 and change right now? We're looking pretty, and we're not too far away from the all-time high. Are you adjusting your forecast, or do you want to just wait and see how things play out?
Well, I'd like to see how things play out. I have a 12-month target of 6240, which equates to about a 6,050 level on a year end for 2025, because we do have to see some things turn around, not just the prices and not just the rhetoric. Bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. Unfortunately, the market tends to peak about 6 months before a recession starts. So, that would be in the third quarter if we do end up with a recession. Also, what we find is that bear markets with recessions decline an average 35%. Even if you have a bear market without a recession, the average decline is 28%. So in both of those cases, we could end up going even further. And the one thing that I'm going to be looking at is, are we starting to see any improvement in earnings forecasts? Because right now we're still trading above the 10-year average PE, let alone certainly the 20-year average PE. And that's because at the beginning of this year, estimates from S&P Capital IQ were calling for a near 13% year-on-year gain in 2025 for earnings. At the end of March, it was whittled down to 9%. Today, it's closer to 7%. So we're going to have to do a lot of catching up of earnings forecasts, I think, to justify PE ratios that are starting at a fairly elevated level.
Yeah, I totally agree. But let's not also forget, and I don't hear this on any of the media, the dollar's down 10% against our trading partners. If I'm an exporter, I've got pricing power, and I'm able to come in and I think we're missing that part of the equation, because we've never had the only time. I can't remember last time we had the dollar down 10% against the modern euro, or against the yen.
Right.
And so we sell a lot of stuff to Europe. We sell a lot of products and services. If you're getting a 10% discount, well, I wish I was a salesman in Europe selling high tech or selling communication services right now, because I'm going to beat the crap out of the competition over there. That to me is one of sort of the underneath the cloud here of this. And then the other point I just get quickly is that, again, obviously when we were in the certainty of uncertainty phase here, you throw all the stuff out the window. We've never had a potential recession caused deliberately by the president of the United States. I mean, Smoot-Hawley back in the 30s, they thought that was a good idea to do all these tariffs, and then we took a small recession and turned it into the Great Depression. But you know, we're a different economy these days.
Well,
That was we're 80% services. At that time we were 70% products.
Yeah, actually, back in 1961, President Kennedy started a fight with U.S. Steel because U.S. Steel wanted to raise prices on their products, and President Kennedy said, "No, you can't do that. We're enjoying low inflation. We don't want you to be increasing inflation," which started a pissing match between the two, which caused the S&P to go down 28%. So we did not end up with a recession, but it did trigger a decline in the market. But you're bringing up a good point about exports, because sure, if ours are going to be costing less because the dollar has declined in value, I think that's one of the many reasons why we're not going to be headed for recession. At most, we gave it about a 40% likelihood. But if you look at the different indicators that the NBER, National Bureau of Economic Research, their business cycle dating committee uses when making a decision that we're in a recession, yeah, they look to GDP, they look to retail sales, industrial production, real disposable personal income, et cetera. And all of those factors are remaining positive by our estimates. And so while we might end up seeing a bit of a slowdown, if we do continue to have this tariff tiff, we still don't think that it's going to throw us into a recession.
So,
Yeah, I
so
mean,
you said, hold on there, Toby.
Yeah.
So you said CFRA had a 40% chance of a recession, but it's now changed, and now you're saying no recession?
No, what I'm saying is that we had a 40% chance based on our economic group's assessment of the tariff situation. And quite frankly, I don't know what it's been changed to. But because this is simply a pause that we are experiencing, not much has really changed. So we have to see what kind of volumes start to come into the U.S., et cetera. But I would guess that our estimate of recession probably will go down.
Okay,
Yeah,
go ahead,
I'm
Toby.
just going to make the point that the hardest one to track is small business. And I can tell you just anecdotally, not so much in, rich Scottsdale is that an issue, but I was down in Payson yesterday, which is, a middle-class area. And I was bringing my road cycle in to get tuned up, etc. And I came in and Bill, the owner, I said, "Billy, how's it going?" He says, "Toby,
Your mongoose?
Yeah, don't ask, not my mongoose, you bonehead, my Trex." And he said, "Toby, don't ask. We can't, we had to cancel all the shipments for our bikes because they were going to get hit with that 145% tariff. So now, geez, do I have 90 days to order? Can I get it from China and then get it shipped? I don't know. I have people coming in. This is like prime time to buy bikes and, road cycles. There's a lot of road cyclists out here, Todd. It's not like you, where you guys have sleds and stuff. And
So Toby, when you were talking to your bike dealer, did he get huffy?
Hey, real quick though, with that said, and in all seriousness here, with that said, Sam, will you guys at CFRA, I guess you're going to see just an influx of economic activity, at least over the next 90 days, because like Toby said, now you want to take advantage of the fact that you're not going to be hit with the 145%.
Well, that's certainly, yeah, I think that gives us reason to be optimistic that the market does have further to climb, that we are expecting to see, even though there is the possibility, the potential of a reversal in trend. Our feeling is that not according to Lowry, our technical research arm, not according to our economists. And we saw first quarter earnings that were expected to come in at about 6.5%. Now it's more than 13%, so
yeah.
twice the number. And so my estimate is we'll probably end up seeing an improvement, certainly in the second through fourth quarters of this year, just as we saw an erosion of estimates as the uncertainty deepened regarding the tariffs. So
Yeah,
exactly.
Remaining bullish.
I want to ask Lowry what the lift is going to be to the GDP based off of this, because you're going to now see an acceleration of economic activity that, like Toby said, is manufactured from the White House, but it's going to be force-fed. So that should lift our GDP number, at least for the second quarter, going into the third quarter.
Wait a minute. What you're not counting is just like the bike store that guys all ordered 2x of what they wanted to get before the tariffs happened. We've had a huge front end loading to try to get in before the tariffs, and you get that number from not only CFRA, but we get it from all the economic measurement supply chain stuff. So yeah, those ships were all double loaded with containers, not single loaded. Some of them were quadruple loaded, and they all went into Long Beach and they dumped all that stuff out. And now a ship hasn't left China in 21 days because it's 23 days to get to the United States. So we front loaded a lot of that. So now they have a lot of these people have excess supply. So the question is, in the Q2, if they're not ordering at the normal rate because they front loaded, what does that do to GDP and the product? Again, our economy is 80% services. So at the margin, as we like to say, that's where I think, but we don't know how to model this because we don't really know how much they front loaded. So now you have to figure out what inventories do they have. So people are going to be watching inventories very, very closely in Q2 here and into Q3 to see if in fact we normalize to a normal import thing. And we're not going to normalize until I know what my freaking tariff is going to be.
Yeah. Sam, I tell you, you're going to be working hard tonight with your Texas Instruments calculator, trying to figure this stuff out.
That's right. I'll let my fingers do the walking on those keypads.
Well, remember his backup is a slide rule, Todd. So, I mean, it's...
Thank goodness I have all 10 toes.
Absolutely. So listen, guys, we're going to leave it there on this special report because we know everybody wants to hear what Sam has to say, what Toby has to say. They probably don't want to hear what I have to say, but that's okay because we only bring the experts out to Crosscheck Media.
It's not over yet, Todd. Don't declare victory yet. No premature election.
No mission accomplished. Banners are going up, is what you're trying to say. So, all right, that's the conclusion of this commentary. That's for sure. So, Sam, thank you so much for joining us. We can't wait to have you back for a regular show. We got to follow up on this discussion. I know there's so much more to get to. So,
I left out a comma. So we'll talk again.
Absolutely.
All right.
So on behalf of Sam Stovall and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on this special report for Buy, Hold, Sell. We'll catch you next time. Take care. All right.
Buy, Hold, Sell, brought to you by Crosscheck Management.